If you've kept up with stock market commentary as of late, you would have seen many experienced and professional investors saying that the stock market is currently in a bubble. Well, today I'm going to explain what you need to do as an investor to prepare yourself and protect your profits. How's it going, guys? Ryan here and welcome back to another investing video, and today we are talking about if the stock market is in a bubble and what you need to do as an investor to protect not only your investments but your capital in general. But before we get into that, guys, please remember to give this video a thumbs up. It helps me out so much with the YouTube algorithm, and subscribe for more investing, stock market and wealth management content. I'd love to know your thoughts on what you should do to protect yourself in the comments section below after you've watched the video. So without further ado, let's get straight into it. Firstly, what is a stock market bubble? Well, a stock market bubble is effectively where the values of companies and their stock prices are significantly overvalued, and the value of them from a pricing perspective is higher than the actual intrinsic value of the company itself, effectively meaning that the prices are inflated. The reason that many commentators are actually saying we're in a stock market bubble right now is due to the fact that we are in a global pandemic, not only for the sense of COVID-19, but more importantly, the economic impact that has occurred. And what we're seeing is that the governments are propping up economies around the world, and as a result, the prices and valuations of companies continue to rise as a result, and have in many cases actually exceeded their values from where they were at the start of the COVID drop, which is absolutely insane. So as a result, these commentators are saying that stocks at the moment are overvalued and not worth their intrinsic value, and as a result, you need to be careful as an investor. Now, if you haven't worked it out already, the key issue with a bubble is that it can pop. And effectively what that means is you're going to see a sharp decrease in the price of stocks and companies around the world, because there is a much higher price that has been put on them than what they're actually valued at. As a result, if you are investing in the stock market right now, that could mean that you are going to lose a lot of money if a drop like this does occur. So today I'm going to share with you a few key ways to protect your investments and make sure you don't lose out on capital. The first thing that you want to do before you see a bubble pop is take the money that you have invested in the stock market out that you genuinely cannot afford to lose. So if you are invested in stocks, if you put your life savings into stocks for whatever reason and it's something you can't afford to lose, make sure you take a portion of that money out. The worst thing that can occur is all of a sudden overnight the stock market absolutely plummets. You lose 50% of your cash that you have invested, and effectively you are becoming broke or you're heavily in debt as a result. You may have loans and that sort of thing that you were planning on using these stocks profits to pay, but that has disappeared overnight. And worse, if you are not in profit on your stocks already, then you will be losing money, losing your actual capital that you've invested in the first place, and this can lead to some serious issues down the track. Step number 2, if you are willing to keep investing in the stock market, make sure you invest in companies that have stood the test of time or have a solid foundation to survive a crash. So what you want to be looking for is companies that are effectively generating a profit, a turnover that will not be affected from an operational or from a profit point of view if a stock market crash does occur. So typically we're going to be looking at more of our blue chip stable companies here, which regularly, pay out dividends or regularly increase 5% per annum, that sort of thing. These are the types of companies which will be able to survive stock market crashes. Step number 3, do not invest in companies that have gone up in value on hot air. These are the main companies which are going to absolutely plummet in value. So for instance, if you've invested in a biotech company, for instance, and they have a potential COVID vaccine, if there are results which haven't been released, but the share price has increased hundreds of percent prior to it occurring, and we don't generally know the outcome, then this is probably not a good stock to be invested in at this point in time because the risk level is so high. If the stock market bubble were to burst and those results were unsuccessful or there was pushbacks, you can almost guarantee that there would be an insane drop in the value of that stock, and as a result, if you're in it, you will likely lose a decent chunk of money. Step number 4, refer back and stick to your investing strategy. This is the best thing you can do so you keep all your emotions out of your investments. If you're going to continue to invest, make sure you stick to that strategy. Make sure you have your entry points, your exit points. If you're investing in companies with solid fundamentals, make sure that those fundamentals do not change. If they do as a result of a stock market crash, or they are at threat of failing as a result, you want to make sure you preserve your capital now and get out early. But stick to your plan. Make sure your emotions do not get involved, because if you start making rash and emotional decisions, they are going to result in you either A, missing out on potential profit, B, losing a lot of money, or C, you're just going to exit the stock market completely because you are not interested in the stress that emotional investing and trading brings. So make sure you focus on that plan. Make sure that plan is very well structured and it is your key focus. Step number 5, and this is something I don't actually say too often, and this is to diversify, but not to a ridiculous level. You just want to make sure you don't have all your eggs in one basket. So for instance, if you've got 100% of your shares in Tesla, then all of a sudden the tech bubble bursts or the EV bubble bursts, whatever it may be, and Tesla cops it as a result, and it goes down 50% from its current value over the period of a few weeks. You want to make sure you're not caught out just holding that stock. So make sure you spread your investments, whether it be, just a couple, or whether it be 5, 10, 20, whatever it may be, spread it across different industries, different sectors, different companies. Just make sure your eggs aren't in one place that is likely going to get hit, because that is when you will suffer. Hopefully you're invested in a variety of blue chip companies and, maybe you're more risky companies as well, but it might be time to transition some of that capital from the riskier investments, take some profits and put them into more stable investments so that you have got all your bases covered. And that, guys, is 5 key steps on preserving your capital, making sure that you do not suffer if a stock market bubble does burst. I hope you did enjoy today's video, and if you did, please remember to give it a thumbs up and subscribe for more investing, stock market and wealth management content. I'd love to know your thoughts down in the comments section below on whether we're in a bubble or not, or things you can do or you do yourself to preserve your own capital in a situation where a stock market bubble does burst. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.